Hello and welcome to the second episode of the Ambiguously Analytical Podcast. I'm Alven.
I'm Michael.
Good to see you, Michael. We made it to the second episode.
We did. We got over the first big hurdle, right?
Yeah.
Episode 2.
But sadly, in the United States and in all over the world, we're experiencing a massive resurgence of COVID-19.
Yeah, the long-awaited second wave for the rest of the world, and for the U.S., the third wave.
Yeah, pretty much.
One interesting thing, though, Alvin, from one of the articles I was reading from actually on People about this third wave, they had quite an interesting map, actually, of the locations that are most infected right now. They're seeing the highest infection growth.
Right, and let's look at this map.
Yeah.
So we have California, New York, Vermont, and all these places maintaining a fairly low COVID-19 cases.
Yeah, and then you see the center of the country is kind of exploding with COVID cases, presumably due to low mask wearing, and it's also getting colder, so people in those areas are probably doing a lot more indoor activities, which means they're a lot more exposed to COVID if someone they're doing the activity with has COVID. Most of the places that had a bad outbreak before
Right.
Are not having a bad outbreak right now because people have already seen it. And so it's really the middle of the country, center, the areas that didn't have a huge, terrifying outbreak in the beginning.
Well, hopefully everyone take safety precaution and we'll get over this soon.
Right, like Fauci's saying, everyone needs to be wearing a mask to protect other people from you on the off chance that you have COVID or are asymptomatic. So, even if you feel super strong, you should still be wearing a mask so you don't kill grandma.
Correct.
Yeah.
Correct.
So why don't we start a little bit with the impact of the COVID shutdown on the U.S. economy. So obviously, GDP growth is down a bit, to nobody's surprise due to all the shutdowns.
Mm-hmm.
Especially the U.S. is essentially a service economy, and so some of these services shut down in the middle of a pandemic, and some of them don't have to, like tech companies, but a very large number of them do shut down in the middle. You can't have a restaurant, you can't have concerts, you can't have these kinds of things. You can't have these kinds of things going on in the middle of the pandemic, right? Where you create a massive wave of infections, right? So I think, in the short run, we've got some stimulus. Well, we had the stimulus, and some areas had very good stimulus, like in New York, like COVID income support. But, for now, what we're going to see is after this ends, people are probably going to be shifting towards a more financial habits that involve more saving. People are just going to save more. Like, Americans are notoriously bad at saving. Because we just haven't had this kind of massive crisis that a lot of people in other countries are sometimes paranoid about, rightly so. Rightly so.
We're consumer economy.
It's a consumption-focused economy, right? And so, as a result of COVID, people are more likely to be saving, So you're going to see people who weren't saving much before begin to save. And, there are a lot of people who are kind of living paycheck to paycheck, and can't save, haven't been able to save, particularly people with lower incomes, but there's still a significant number of people who were not saving who definitely could have been saving. You must know at least a couple bankers who just blow through their entire salary every month and literally save nothing, and their retirement plan is, I'm going to make millions of dollars when I'm older, Like, I can't count the number of classmates and people who I just happen to know who literally just don't save. Like, they just spend everything every month. And sometimes they spend more than they earn every month. So I think that is going to be a huge change. People are going to be way more focused on saving. or at least doing something with their money other than buying brunch. And because of how consumption focused the US economy is, I think this is going to slow the recovery down beyond what people are kind of expecting. I mean, there's obviously the whole K-shaped recovery thing, right?
Yeah.
But without consumption, the lower end of the spectrum is not going to recover very quickly. So I personally have seen a huge number of bars have just like shifted the way they do business, right?
Right.
It's like the bars that previously were just selling alcohol are now selling food, right?
Yeah.
It's a requirement, right?
Yeah,
So,
and they started doing provisions and groceries.
Yeah, exactly. A lot of companies have kind of branched out, or restaurants have branched out, particularly the ones that are actually making money right now, right?
Yeah.
So I think what this is going to show, or what the cause of this is like, it's actually going to be a little bit less specialization in New York, at least on the low end. And like, I think New York has always been competitive, right?
Yeah.
But there's always been that kind of undercurrent of strong investment. And so that is less present in the middle of the pandemic, right? So people kind of have to do what they can to survive. And so as a result, I think that the companies that do still exist here are going to be stronger, kind of in the way you typically see during any kind of economic downturn.
Right.
But I think in this specific case, it's kind of like breeding a flexibility with the companies that are around that it's gonna enable them to kind of survive a bit better than maybe they typically would in these downturns. On a more, like on a broader scale, you're gonna see just way less consumption here in general, like we were saying before, even in the aftermath of the worst of the infection, we're still seeing a lot less consumption,
Yeah.
And even stuff like public transit and subway ridership is down, So that's something a lot of people haven't been talking about, is like this idea that we come out of this crisis and suddenly everything's back to normal. Well, it's not going to be, because all of a sudden the government is going to need a lot more money because the government's, further and further in debt, right?
Right.
And stuff like public transit is like ridership in the subway is down to like 25% of what it was before. So MTA is going to be losing money. So I think this is going to be something you'll be seeing in general, is public transit's going to be in an even worse situation than it was before. So in general, I mean, what do you think that means at the end? It means these areas are not really going to have any choice but to do some kind of money-making measure, which is probably going to be taxes, right?
Yeah.
I guess the main thing I'm saying is we'll see more taxes in New York and a lot stronger businesses that did survive. Well, in terms of like the normal people in New York, though, I think there's been quite a bit of change, particularly in younger people, because I feel like out of the two groups affected the most by the pandemic have been the poor and the uneducated. And younger people tend to be poorer, and they tend to have less education, less job experience.
Yeah.
It's
Hey.
it's largely it's largely harder for them to just find a new job all of a sudden, right? So I mean, what kind of habits like have you seen among your friends? Like, what have you seen changing in their behavior, particularly when we're talking about like financial behavior?
Well, I guess I could start with actually career choices. People are being more open to opportunities that used to be considered like the peripheral of what they were, of their job prospects, right? If, let's say, if I wanted to be a banker, now I might have to start considering, working as an accountant. People are more open to shifting or pivoting towards other directions in terms of their career, just because there aren't enough opportunities that are out there, right? People who are, maybe in college, or maybe or like new graduates of college or any higher education are starting to realize that they need to do something to plan for something like this in the future.
Right.
Right.
Yeah, I guess that makes a lot of sense. And particularly for younger people, I would imagine a lot of the what you consider the traditional avenues for planning for your
Right.
future are less available now. Since if you're facing unemployment, it's a little bit harder to do anything with a 401k, right?
Yeah, and you have tons of student debts.
Yeah, you have student debt.
For most students.
Oh God, I didn't think of that. Yeah.
Yeah.
The student debt's riding on them. They don't have the ability to put anything into a 401k if they're unemployed, or or it's much more difficult at any rate to put anything into a 401k.
Right.
Obviously, there are no ninja loans these days. For viewers who don't know what that is, there's a no income, no job loan.
Yeah.
So there are no ninja loans since the banks are kind of like sucking up all the funding right now and being very conservative so that they don't collapse. So I guess there aren't very many avenues for young people these days, aside from something like investing, just investing in general, right?
Yeah, I mean, it just makes a lot of sense that if you're a student who's mildly interested in making money, which who is not, and you don't have you just got out of college and you don't have a job yet, you're bored, and you're, first of all, you're bored. Second of all, you have to find a way to stay afloat, right? And it's not like you could get a part-time job as a host at a restaurant anymore.
Right.
A lot of people have started to invest using stuff like Robinhood, maybe Betterment, things that you can invest at a low cost.
Right. So I think it's pretty interesting that we're talking about this now, since retail investing as a whole has been growing rapidly recently, and
Right.
The pandemic has certainly lit a fire under these apps and caused them to grow their user base massively, right?
For sure.
And so, I think this has all kind of been buoyed up by things like you mentioned, Robinhood, which is kind of different from a lot of other investing apps in that it's a lot easier to use. It's a lot less complex.
It's very gamified.
Yeah, exactly. It's very gamified. That's a wonderful way to put it. It's gamified. And so it's like got super like sexy animations when things are going up or down. Like in general, it's just much easier to use, right? And this is accompanied by Robinhood and these other similar apps being commissionless, right?
Yeah.
It's commissionless trading. So you can trade all day or whatever, and you don't actually pay for it. So these new apps are definitely fueling some kind of growth in the retail market. And you can actually see it in the numbers, right? Because one thing you might not know is after the Great Recession, back in 2008, 2009, retail investing was only like 10%, right? Something like that. 10% of traders were retail investors, right? And now we're seeing
sounds like about right.
Yeah, and now we're actually seeing, over the past year, it's grown up to like 25 to 30% of trades are from retail investors. This huge growth in retail investing, right?
Right.
It's of course led to a bunch of different ways for these people to communicate, right? Or for new people to kind of, if not actually become knowledgeable, to at least feel that they're knowledgeable, right?
Yeah.
So we see the growth of things like Wallstreetbets, Instagram and TikTok people who just pump stocks, talk about investment. Like, do you have why don't we talk a bit about Wallstreetbets? It's just so crazy that it's like, that place is so crazy that it's just such an interesting topic, I think.
Yeah.
Like, you've looked at it before?
Yeah, they have this huge culture of risk taking. You know,
Right.
people would post screenshots of them not just winning money, but also like losing a lot of money.
Right. They call it loss porn.
Yeah,
Like
yeah,
some guy nuking his retirement account, like losing like literally hundreds of thousands of dollars trading
yeah,
options, right?
yeah. And I think, I mean, there's a lot of you could talk a lot about why that it's an existing culture, but I think essentially, I think Wall Street Bets is a snapshot, or what they call it, a microplasm of how,
Microcosm, yeah.
yeah, how younger people are more willing to take risks
Yeah.
these days,
Yeah, I
right?
think it's pretty insightful, yeah. The
Yeah. Sorry, go
I,
ahead.
no, I think you're totally right. Like Wall Street Bets is kind of just this ultimate high risk, high reward environment. And
Yeah.
I think that becomes much more appealing to people in the middle of a recession,
Yeah.
or I mean, it could also you could draw some parallels maybe to the 20s, the Roaring 20s,
Yeah.
because stock trading among individuals was at an all-time high right before
Hmm.
the enormous, terrifying crash. I can't remember. It was Black Friday, Black Tuesday. So I remember reading that like way back when that during the 20s at the height of the stock trading was when everything collapsed, right?
Yeah.
And so that has been kind of interesting to me, just because you see this enormous growth in tech stocks where the PE ratio is just out of control,
Mm.
right?
Mm.
Like you're seeing PE ratios like 300, absolutely insane when compared to earnings and equity, right?
Right.
The valuation. So, uh, I mean, don't you think this kind of this growth in tech stocks kind of help fuel it? Like, I mean, you are a newer investor, right? More so than me.
Fairly
I
new.
like,
Yeah. Yeah.
so maybe you can tell me a little bit what drew you into investing. Like,
Um, yeah, it's interesting. Well, I hadn't gotten into investing until the first cryptocurrency Bitcoin boom.
yeah,
So the first time I ever invested in something was actually in cryptocurrency.
okay,
And again, I think I'm like a pretty good representation of my generation, or people who are maybe slightly older than me, but generally, older Gen X and millennials. We're very drawn to excitement because, well, when you're young, right? And
yeah,
for better or for worse, if you have a passion in certain financial products and you do the proper research and you invest rationally, um, it's not necessarily bad that you're only interested in cryptocurrency or whatever.
right,
And of course, I moved on to other stuff uh, since I essentially stopped trading crypto.
right,
But um, but yeah, I think psychologically, especially intensified by the pandemic, we're seeing a lot of young people uh, wanting to find this sort of excitement in investing, in trading stock and
yeah,
options. And I think the whole mentality isn't the only thing that have pushed people towards trading stocks and options, right? Because if you look at the stock market or you look at the financial markets in general, there aren't a lot of other options, or like more conservative options for you to choose from at this point.
yeah,
At at a zero interest rate, there's no point in buying treasury bonds. There's also, I mean, if you're buying corporate bonds, you're facing the same amount of default risk as if you're just buying stocks. So people who, this, I mean, this applies to like even institutional investors and retail investors. People don't have the, they're people are being pushed to, you know, equities trading way more than before.
Right. And, you know, one of the things that's been interesting about this growth, right? We're talking about how it's younger people who are really interested in like risk-seeking behavior, right?
Right.
And you know they've traditionally been investing in tech stuff, right?
Right.
Just because that's been the high growth, right? And that's kind of what's been drawing people to, right?
Yeah.
So you got these little like, and if you need to figure out the age of the people on Wallstreetbets, you can kind of generally figure it out by the huge number of memes on the forum, and like the absolute glorification of absolute insanity, like really insane stuff. Like you see some guy who
it's probably not a 65-year-old dentist from Long Island
particularly
that's
not the
posting
guy,
these memes.
Particularly not the guy who got their logo tattooed on his butt. Like I don't know if you saw that, but that was on there yesterday. Some guy, apparently like a month ago, 2 months ago. I didn't catch it when it happened. I like go on there, you know, a couple times a week and just to see what they're doing.
Yeah.
And like this guy bet his student loan money on some kind of risky plays, right?
Wow.
Lost almost all of it. And he's like, if the market is green tomorrow, because he's a bear, you know, he's like betting the economy is going to crash or something like that. The market was going to crash anyway.
Right.
Since the two aren't really related. He's betting the market's going to crash, right? And if it didn't crash, he said he was going to get the logo tattooed on his butt, and lo and behold, next day the market was in the green. So the guy actually ponied up, and he's got a tattoo on his butt of the Wallstreetbets logo.
Oh God.
Right?
Yeah.
All right. So you know, yeah.
Yeah, I mean that's interesting. It's I think in finance we've always observed this trend of a strong culture, whether in risk taking or, you know, working hard towards your goals, that like Wolf of Wall Street kind of vibe.
Yeah, the
yeah,
the whole tiger walking around and the cocaine parties and whatnot from the movies. Probably that also happened in reality.
Yeah.
Well, I would say actually I've met more people who are in art that use cocaine than bankers, to be honest.
And for people who are, you know, maybe not part of that culture, but still are doing the same thing, they're still trying to find a convexity area to make a profit. Yeah. Right. But I think what's different with Wallstreetbets or the time we're in now is that we're seeing technology like social media producing these single person like influencers making you know $1 million of changes in the stock market. Right. And so I think, you know, one of the things again that's been fueling that has been just the kind of immunity of tech stocks to the downturn, and you know, that's obviously partially because they didn't have to shut down so much because it's a lot easier to do remote work for a tech company. Right. But one of the things that is kind of overlooked in why the tech stocks have grown so much has actually been options trading. Because like you've been saying, a lot of these people were drawn to investing because of huge gains, right? Or just seeing images from influencers or other people of huge gains. Like obviously people on Wallstreetbets love the last four and they love to watch each other, you know, piss away their savings, but everybody's there because ultimately they want to make money, right? Like they aren't there to lose their money. At least, you know, they'll joke about it, but they aren't really there to lose their money. I mean, maybe they're there for the memes now, but you know, the in reality they're there for money, right? And options are a super risky, very gambly way to make a lot of money very quickly, right? And so one thing people don't think about is that when you're trading in options, right, there's a market maker somewhere that has to, you know, they have to hedge. Like, what if it goes, you know, what if they actually have to make that option whole, right? Like, what if someone like buys a bunch of calls and then the stock actually goes up,
then the market maker has to sell at that price, right?
Right.
So what happens when you buy a bunch of calls? What does that mean? That means that the market maker is often going to buy, yeah, exactly. They have to hedge. So they immediately start buying the stock. So you have this massive growth in options trading, right?
Yeah.
You have a ton of people buying Tesla. There's actually some interesting due diligence on Wallstreetbets. I'll say that. Sometimes it's good. Sometimes it's like my mailman told me that UPS is going to do super well this year. And it's like, oh, okay, well, let's all buy UPS then, right? Anyway,
yeah.
but yeah, so anytime you got these posts on Wallstreetbets, a lot of people buy options, right? And like, you know, the most common call options are going to be tech stocks, right? And so as a result, these actual market makers have to buy these stocks. And so the huge growth in buying options is actually increasing tech stocks.
Right.
Like that's my view anyway. I don't know, you know, so it's kind of like a self-reinforcing cycle, you know, like I would call it a vicious cycle, I guess, but is that even the right word? Like I think usually vicious like cycles for stuff that's spiraling downward. I guess the term for this is
self-fueling cycle.
Yeah, well, I guess the term for this is actually virtuous cycle, but given what's going on, I don't really want to call it virtuous.
Yeah, I mean, who knows? But I think it's definitely a form of distortion.
Yeah, absolutely.
Yeah, where you have like an agenda or a strategy to basically force dealers in the market to delta hedge. Right. So, and that leads to more money.
Right. Yeah. What do you think the long-term impact of all this is going to be? Like, assuming this isn't some flash in the pan, and when the whole crisis is over, people stop investing in Robinhood or something.
That's very interesting to think about. It's because like once you open the Pandora's box of option trading, of, you know, that excitement, it's hard to close it up. No one can say for sure, because there are people who are making this into a full-time job.
Yeah.
Right. But there are also people who are, you know, like you said, tattooing their logo onto their butt.
Yeah. I mean, yeah, that's a good point. I mean, it's just kind of hard to say what will actually happen if it's going to be a long-term cultural change. Because, you know, memes aside, what's going to happen when large numbers of these people actually lose money? Like, obviously, we have the absolute insane gamblers that are kind of doing the lost ownership, but then there's only so much money to lose, right? Like, so, you know, what happens in the long run? Like, do these investors become more sophisticated? Do they become more skillful? Does the average knowledge base of a retail investor go up in the long run? And I kind of think it will. Yeah. And one thing that I'm kind of curious about, and that I've been theorizing about in my head, I'm a little curious to hear what you think of this, is do you think that I have this theory that that in the long run you're going to have people basing trading algorithms and like large institutional money, like smart money, will be basing their own trading patterns off of the chatter on these kinds of investing forums. Not necessarily because they think they're, you know, right, but maybe because smart money knows driving something.
Forces of the market.
Right. The smart money might know something that these other guys don't know, and that the average person doesn't know. And by looking at what these people are excited about or what they're chattering about, they would be able to somehow make a bit more money, right? Like if they happen to know stocks can go down because of some better due diligence they do, or whether it's some kind of inside information that they're not actually supposed to have. I think they're going to be taking advantage of this kind of growth,
for sure.
Not only in the size of the retail market, but in the degree to which retail investors communicate their intentions.
Right. It really just depends on what the algorithms and what kind of models that they're using. But if this goes on long enough, I think there's a huge chance of large institutions altering their models to fit some of the to utilize some of these information that they can get from like Reddit, right? if you
Right.
have, if we observe volatility, or any product reacting fast enough to Reddit posts, there's definitely a chance where you can write an algorithm that reacts faster to the to whatever information that's on Reddit, on Wallstreetbets, or whatever, I don't know, TikTok, whatever that people are likely to use in the future.
TikTok dancing investment tips.
Yeah.
The dancing
Maybe,
investor. Someone should do that.
yeah, maybe everyone will filter through all the videos and see what kind of dance move affect the stock
Computer
market
vision.
the most.
But yeah, I mean, that's a pretty good point, is that algorithm can kind of take advantage of this information before your average person who's just reading can. So maybe these
because you can't just feed me 1,000 videos or 1,000 Reddit posts and ask me what conclusion, what's the main thesis, or what information I get. But you can do that with any algorithm.
Right. With an algorithm, maybe you could say, like, this stock has been mentioned this often in the past week or two, which means probably a lot of retail investors are going to start buying it. So we should buy it and then sell it in a week or something like that.
Right.
So, it would be pretty interesting to follow, I think. Whether that information is going to be public or whether it's going to be one of those kind of inside secret information that a lot of people who are involved in that industry try not to talk about too much, who knows, like, or can't talk about due to some kind of NDA, like, constantly, who knows. But one other, thing that I think kind of grew the stock market during that time also was the stimulus, right?
The fiscal
like, just
stimulus,
the impact of the stimulus, this sudden free money, like, so to speak. I think that also had a bit of an impact on it. And like what, I think it actually kind of helped feed the bubble, right? Or assuming this is a bubble. I kind of feel like it has to be a bubble when you've got such huge PE ratios, but
yeah.
But then again,
there really isn't any other options.
Right. I mean, the lack of options is definitely a huge issue.
Right.
Just until the recovery, you can't start throwing money into into new ventures, right?
Mm-hmm.
Or you can, but it's much more difficult. Mm-hmm. Do you think? Come to think of it, do you think that means the market might actually go down when the actual economy starts to recover?
I can't speak on whether like the general direction where it's going, but I think just based on existing data, I think I could say that expectation of volatility is going to be significantly lower.
Yeah.
Because we're expecting. So before the pandemic in general, if you look at what is it called, VIX Futures Index, which is a measurement of what people expect the volatility would be in the future. Before pandemic, people in the market expected more volatility in the long term, in the future, than in the relatively short term. But it has been the index has been negative for, I think, more than 6 months, which means that most people expect more volatility, more shakeups in the short term than in the long term. So I think we can see, after, again, the dust is settled, we can see less volatility in the financial markets.
Interesting. Speaking of volatility in financial markets, one thing that has been driving that volatility has been the endless, is there or is there not going to be a second stimulus?
Yeah.
Right. So I do not think that there's going to be a stimulus until obviously there's no stimulus till after the election. That's not, no way will there ever be a stimulus until the election is over.
Yeah.
Maybe if Trump wins, maybe there might be a stimulus in the near term. but it's really hard to say. And if there is a stimulus, expect it to only go to red states. I mean, honestly, like the government
Only go to what?
said that. Red states, like states that voted for Trump. I mean, or at least battleground states might be included, but you're not going to see it be going to places like New York and California, which is going to be pretty bad for the economy overall. Because a lot of growth does come from those states. Those states buy goods and services from the middle of the country. You know, it's all related. Okay. So first off, we're seeing Biden polling at like 90%. You know, 90% chance to win the election.
Yeah.
Based on the current numbers.
Right.
Like it is very likely he's going to win. You know. Yeah. Whatever your opinion is, that is basically what the vast majority of people are expecting to happen. And in Congress, people are expecting that too.
Right.
And you know, the stimulus has already passed the House. So the reason there hasn't been a stimulus yet is the Senate. So you look at who's in control of the Senate right now, right? It's Republicans. Specifically, it's kind of, you know, everything kind of comes from Mitch McConnell. He's like, whether he's the mastermind or not, who knows? Right. But he is the public face of the Republican Party in the Senate, right?
Right.
He kind of absorbs all the criticism, and because he's in a relatively safe district, he just takes it on, carries it on his back, and all the other Republican senators can kind of say they don't believe in it, whether they do or not, you know, is kind of irrelevant.
Yeah.
I would point out that he's still the leader, so they probably do. But if Biden wins, right?
Right.
What reason does McConnell have, from like a purely Machiavellian perspective, to pass a stimulus?
I don't know. There's no.
Because what's the stimulus going to do? It's going to help the economy, right?
Yeah.
And so. Yeah. How did Republicans come surging into power, right? Back in 2010, they took over the House and the Senate, at least the House. I don't remember if it was the House and Senate, but anyway, they took over control, like significant control of the government.
Right.
And that was essentially because the Obama administration was still dealing with the fallout from the Great Recession, right? So what's going to happen is, you know, this time, like, there's no incentive for the Republican Party to actually improve the economy if they don't think Trump is going to win.
Yeah.
So as a result,
they're not going to want to make Biden look good.
Right. So, you know, whether you're a Republican or not, this is just what's going to happen. McConnell's not going to pass the stimulus because he or the Republican Party in the Senate or whatever you want to say, there's no interest from them in improving the economy right now, because ideally for them, the economy in the short term takes a nosedive and then it's blamed on Biden. So we're very unlikely to be seeing any kind of stimulus. And this is something I think a lot of people who examine financial markets don't really think about, is political risk. You know, this is a form of political risk. Yeah. And you know, you're talking about if you're talking about investing in Asia or something like that, you've got issues of you know, unstable governments or whatever. You're talking about investing in Africa, unstable governments, South America, same thing. You know, there are all sorts of, and now we're seeing this kind of political risk being an issue in the U.S.
Yeah, that's a great argument. I mean, it's just, I mean, it goes to show that as much economists could push for, or, you know, any scholar or activist could push for a stimulus, in the end, these decisions are going to be made at the House and the Senate.
Yeah, exactly. So whatever is best for the economy is not necessarily what's going to happen.
Yeah,
it's ultimately based on political. The political will to pass it, and I don't think there's political will. Particularly if Biden wins. So what that would mean essentially is, you know, the next stimulus probably won't be coming until January, if there is one at all. And so I'm kind of curious to how the market's going to react to that. But I think it would be pretty interesting to talk about kind of what the actual impact of the original stimulus was and what the impact of a second stimulus would be. And so maybe that's a pretty good topic for our next podcast.
Yeah.
Maybe a little bit about the election too, and anything else that kind of comes up in the week that we can talk about. So if you guys are curious about the economic stimulus and the original stimulus and where the money went, where it should go, where we think it should go, what is in the next stimulus that has passed the House.
Mhm.
Tune in next week, right?
Yeah, see you next week. We'll
Yeah,
see you
so
soon. Thanks
thanks
for
everybody.
watching.
Thanks for watching, guys. And
All right.
until next time, right?
Have a great week.
Yeah, have a
Bye.
great. Bye bye.